CA Manoj Kumar Yadav here. Welcome you all again in this short informative video on official YouTube channel of Let's Talk for Awareness. Basically, this video is a part of a series on stock market activities and its taxation, wholly focusing on classification and reclassification of stock market transaction and its tax implication. Just before we dive into a tax implication part, let's do a little catch up of what are the transactions you may be performing related to stock market or stock trading or investing. So I think you may be one of them who may buy or sell stock and square up the position on the same day, also known as intraday trading, a situation where the stock never entered into your demat account. Maybe one of them who buy stock and hold for some time, also known as day trading or momentum trading or position trading. Broadly saying, delivery based trading. After one day of your transaction, it becomes a delivery based. Or you may be one of them who deals in a derivative, F&O, commodity or currency trading or transactions. There has always been a confusion and litigations regarding the classification of income between a business or a capital gain. And this quantum of confusion will be more when we talk about the shares and the stock, including derivatives, commodity, currency, or whatnot. It may include the debt itself. So it is really very important to know the difference in a tax treatment, because the tax liability of individual will depend on this. As a right classification of income play an important role as the method of computation, its calculation, deductions, relief, incentives, and the tax rates prescribed for capital gain and the business gain are completely different. So friends, if you are also confused and having any sort of doubt in deciding what will be the tax implication while dealing with the shares and security with any of its forms, maybe equity or debt, maybe intraday, F&O, currency, commodity trading, whether your transaction is executed in a recognized market or off the market, or you are one of them who frequently switching from trading to investing, or a vice versa, without realizing the tax consequences and its impact, then this video is only for you. So what to do? Nothing. Watch it completely using the link given below in a description box. Friends, once you have decided the nature of your all the transaction which you are making in a market, stock market, whether it is a trading or as an investing, now it's time to classify yourself as a trader or investor. Broadly speaking, you can classify all stock related transaction into four categories. One is known as a long-term capital gain, another is a short-term capital gain, a speculative business income, and a non-speculative business income. Now let us understand what each of these mean. So taking first angle, if you classify yourself as an investor by considering all your transactions and want to know its tax implication. Currently in India, if investment and the consequent sale of listed share or equity mutual funds were done after 12 months of its holding in a recognized stock exchange like NSE or BSE, and you have paid a security transaction tax STT on such transactions, then as per section 112A of Income Tax Act, any gains so realized and must be categorized as a long-term capital gain, and which is completely exempt from the tax for first 1 lakh rupees and tax at a 10% above or excess rupees 1 lakh. Whereas the holding for more than 1 day, also called delivery based, and selling them within a 12 month or you can say a year from the date of purchase can be categorized under short-term capital gain or STCG. Currently, as per the section 111A of Income Tax Act, short-term capital gain is liable to be taxed at flat 15% rate. Friends, whereas these investment and their consequent sales were done through an off-market transaction, then irrespective of whether it is a listed or unlisted stock, tax on long-term capital gain is 20% with a indexation benefit, or you can opt for 10%. Both the option is available only for the resident individual and HUF. But in case if you are a non-resident, then you are having only one option, that is 10% of tax. Similarly, tax on short-term capital gain is done normally as per the slab rate applicable to the person. Friends, if you want to know more about how the taxation on listed shares or taxation on unlisted shares is done, please do access our other videos. Link is pinned in description box, or you can click I button. Let's have a clarity with some hypothetical situations here. Assuming by using a lot of research and study you found one share and buy a stock of SBI today, say for ₹1 lakh, and sell the same after 365 days or any time after 12 months at ₹1,55,000. So the difference between 1,55,000 and 1 lakh is known as a profit or gain of 55,000 is considered as a long-term capital gain and taxed at a 10%. So in this case, 55,000 is a long-term capital gain which is going to be taxed at a 10%. So the tax liability comes here is 5,500 rupees. But thanks to exemption of 1 lakh, you need not to pay any tax in case of long-term capital gain. So your net tax liability is 0 in this case. I think it is clear, and if it is clear, then can you make a guess? Suppose if you sold same SBI share within the period of a 12 month, or say 10 days later you purchase at ₹1,55,000. Is it making any difference in tax liability? If your answer is yes, then you are correct at this point. The difference of ₹55,000 means 1,55,000 and 1 lakh is taxed as a short-term capital gain, and you are liable to pay 15% on ₹55,000. That is somehow 8,250 rupees as a tax. If it is also clear, then can we make another guess? What if the above transaction is an off-market transaction, and assuming you comes in a 30% tax bracket? Now, is it make any difference in tax liability? If your answer is again yes, really happy to know you are correct at this point also. Your tax liability will be on long-term capital gain at the rate of 20% with indexation, or 10% for you can opt any of them. So your difference comes to 55,000. We assuming you are opting for indexation option, 20% tax is going to be paid. So in this situation, you are going to pay 11,000 as a tax in case of long-term capital gain. The tax liability if on short-term capital gain is going to be calculated, where the slab rate or the bracket, the tax bracket in which you are coming, means normal taxation is going to be done, and normal taxation which is applied in this situation to you is 30%. So the short-term capital gain at the rate of 30% shall be around 16,500. So in different situations we have calculated the short-term, long-term capital gain if the transaction is in a market or off the market. So there is a different tax liability arising. From whole this experiment, we reached to a conclusion that a period of holding and where this transaction happen in a stock market or not is having a direct bearing on your tax liability. Moving ahead, looking towards a different angle, if you classify yourself as a trader, earlier we have classified ourselves as an investor. So if you classify yourself as a trader by considering all your dealing in shares or security as a business activity, so namely a speculative and non-speculative business income will arise here, and you want to know the tax implication of that. So taking one by one, the first and the foremost important thing about the taxation of business activity is that there is no fixed rate for taxation as like capital gain tax rate. Simply mean, if you have a business income, it has to be added to your rest of your total or other income, and tax has to be paid as per the tax slab you fall in. Let us understand the treatment of a speculative business income. The income tax provision has not defined speculative income, but has defined a speculative transactions. Therefore, it can be concluded that the income derived from speculative transaction is a speculative income. As per section 43, subsection 5 of Income Tax Act 1961, the profit earned by trading equity or stock for intraday or non-delivery is categorized under speculative business income. Currency trading, unless you are using currency derivative to hedge some risk, is also considered as speculative. The reason is there is no STT levied. So the point here is that one need to club the speculative business income with the other income source and identify the taxable amount. Once this is done, the tax has to be paid based on the tax slab belong to person or assessee. Moving to non-speculative business income. As per section 43, subsection 5 of Income Tax Act 1961, as trading share is concerned, income from trading futures and option F&O on recognized stock exchange in any segment, whether it is equity, commodity or a currency, is always categorized under non-speculative business income. So mind it here, when we are talking about the intraday activity, it is always on speculative, whereas in F&O, whether it may be an equity or a commodity or currency, it is always classified as a non-speculative business income. As discussed earlier, business income has no fixed tax rate. You are required to add the non-speculative business income to all your other income and pay tax it according to the slab applicable to you. You will be wondering and confused too why the trading equity intraday is considered speculative but the trading F&O is considered non-speculative. Why this different tax treatment given to both? Dear, this is only because when you trade intraday, there is no intention of taking delivery, and hence it is considered a speculative business. But in case of F&O, is defined as a non-speculative by the government, may be as they are used for hedging and also for taking or giving delivery of the underlying contract, even though the currently equity and currency derivative in India are all cash settled, but by definition they give rise to giving and taking delivery. Certain commodity F&O contract like gold have a delivery option to it. So friends, consider always yourself as a trader if you are undertaking any F&O trading or derivative, irrespective of amount of frequency engaged with, or you are engaged with intraday trading, buying and acquiring the position same day, shall be considered speculative business, and or you trade equity on delivery based very actively as if they were a business. In all these cases, you are not having any other option than considering yourself as a trader. But if you trade only in equity delivery based occasionally, you can consider yourself as an investor. Thankfully, one thing that the income tax department clarified was that you can be a trader and investor both at the same time as regard to multiple transaction. But you can't be a trader or investor both at the same time for a single transaction. Mind it here. Simply means you can have a stock meant for an investment for a long term and a stock meant for a short term trades. Similarly, if you are trading F&O or intraday equity trading, you compulsorily have to classify yourself as a trader. But you can still show your long-term investment under the capital gain head to get the benefit of long-term capital gain being exempted from the tax. Sometimes due to the lack of knowledge or considering the need of a time, you are one who frequently switching or reclassifying your stock market related activities from trading to investing or vice versa without realizing the tax consequences. Remember, changing from investor to trader or trader to investor, the way you treat your shareholding will be affected, and ultimately the tax implication is significantly affect your financial too. Let's start with understanding of a tax liability on changing from investor to trader. For instance, you are an investor and dealing in some sort of stock for capital appreciation. And suddenly you changes your activity from investor to trader. Simply means you are your shares changes from capital asset to stock and trade, or bringing your capital asset into your business or whatever business you are going to do or engage with. When this happen, then you have to start holding these shares as a trading stock at their fair market value in a business books at the time of such change made. Income Tax Act having a specific provision, section 45(2) specifically provides that whenever the capital asset is converted into stock in trade by assessee, whatever the profit or gain arising on such conversion shall be charged to tax as a capital gain. But it shall be charged in the year in which such stock in trade is sold or otherwise transferred, not in the year of conversion. Simply saying, capital gain tax liability on such conversion arise in the year of sale or otherwise transferred of such stock in trade rather than year of conversion. So confused? So in order to have a better clarity, let's understand through a situation or in a case. Suppose Mr. A has purchased a share of SBI on 1st May 2018 of financial year 18-19 for rupees 1 lakh and converted the same shares into stock and trade of his stockbroking business on say on 1st June 2020. On the date of a conversion, the fair market value of such shares was 10 lakh. Now such share after conversion is sold for rupees 15 lakh in a financial year say 22-23. We want to know how to determine the capital gain in this situation. So what quantum is a capital gain and what shall be considered a business income in such situation? You can use the current inflation numbers. For year 18-19 it may be 280, for 19-20 it may be 301, and 20-23 it's 350. Let's analyze the situation or the case, which consisting of 3 different stages, where the stage 1, when you buy SBI share or acquired as a personal asset. Stage 2, where the share, the capital asset is converted into stock and trade, and the stage 3, converted share that stock and trade is sold. As regard as capital gain is concerned, capital gain will be a difference between stage 2 and stage 1 value. Means the fair market value at the time of conversion, that is stage 2, and the cost of acquisition or index cost of acquisition, that is a value at stage 1. In order to determine the nature of capital asset, whether it is a long-term capital asset or a short-term capital asset, a period of holding and the indexation benefit in case of long-term capital asset shall be considered from the date of acquisition to the date of conversion, not the date on which the stock in trade sold. So what shall be the capital gain in this situation? We take the fair market value as on the date of conversion of a capital asset into a stock and trade, that is the financial year 2019-20 as a deemed sale consideration that comes to a 10 lakh rupees. Out of that, we are going to reduce the index cost of acquisition. Since it is a long-term capital asset, we assume the indexation benefit is available, and when we index it, the cost of acquisition, index cost of acquisition arises as 1,07,500. This long-term capital gain computed in financial year 2021 means year of conversion, and the amount of capital gain comes to 8,92,500 is going to be chargeable to tax in a financial year 2022-23, that is the year of sale of converted assets. So the capital gain is going to be converted on the basis of a fair market value as on the date of conversion by taking the index cost or cost of acquisition, but the tax liability will arise only in the year when the stock in trade is going to be sold. As regard business income is concerned, the business income will be a difference between the stage 3 and the stage 2, that is a difference between sale consideration of converted shares and the fair market value at the time of conversion. So in our situation, the sale consideration of converted shares in a financial year 2021 or 22 is going to be 15 lakh, Whereas the cost of acquisition, fair market value on the date of conversion is 10 lakh. So the business income is 5 lakh, remaining 5 lakh, which is going to be taxable in the year 22-23. This was when you have converted the capital asset into stock and trade, how the capital gain, tax liability, and the business gain, business income is going to be calculated, and when it is going to be taxed. We have learned, we have gone through that part. Let's understand a tax liability on changing from trader to investor. Means your stock and trade is going to be converted into capital asset. It is a reversal of the situation which we have understood earlier. You must always keep in mind, if your stock market activity changes from trader to investor, your shares are no longer trading stock. Simply means a business asset is converted into capital asset. But provision related to the taxability is not having clarity, as like when capital asset was converted as stock and trade. Hoping while framing the provision of Section 45 of the Act 1961, the legislature has not visualized the situation in other way around, where the stock and trade is so to be converted into investment and later investment sold at a profit. In the absence of any specific provision to deal with this type of situation, a rational formula should be worked out to deal with this type of situation. We can use two formula. Talking about the first formula, which had been deployed the assessing officer AO, considering the difference between the book value of the shares and the market value of share on the date of conversion to be taken as a business income, and the difference between the sale price of the shares and the market value of the share at the date of conversion be taken as a capital gain. Whereas the second formula is concerned, generally adopted by the assessing officer, that is the difference between the sale price of the shares and the cost of acquisition of the share, which was the book value on the date of conversion with indexation from the date of conversion, should be computed as a capital gain. In the absence of specific provision, out of these two formula, the formula which is favorable to the you shall be adopted. The department has given this flexibility to the assessee. Friends, if you follow these simple rules, let me assure you, there is no need to fear from the IT department. But make sure to keep the above points in mind and do consult your chartered accountant before filing your return. Friends, if you really like content of this video, then don't stop your hands to press like, share and subscribe button. Let us know in comment section your valuable feedback. You can ask your doubts too and provide suggestion for further improvement. हमें देखते रहिए और आगे बढ़ते रहिए। इसी उम्मीद के साथ फिर मिलेंगे जल्द एक और इंफॉर्मेटिव वीडियो लेकर के। कमिंग सून। धन्यवाद।